What if you could own a piece of everything? And I mean everything. Not just every stock, but every bond, every building, every single ounce of gold, all at once. It sounds like the ultimate can't-lose investment strategy, doesn't it? Well, let's dive into this idea and see what it really means to buy the entire world. When we think about investing, we often picture this strategic battle against market forces, right? A game of chess with the bear. But what if the very map we're using is flawed? What if the market we're trying to beat is a concept we don't even fully understand? Are we playing with the right game board? Okay, here's the number we're talking about. $250 trillion. That is a number so big it's hard to even wrap your head around. It's the estimated value of every single investable asset on the planet. This is what we're going to call the world portfolio. It's everything, everywhere. So what exactly is in this ultimate global shopping cart? Let's pop the hood on this massive number and really see what the world's wealth is made of. So the concept here is simple, but really, really powerful. The world portfolio is the grand total of all public stocks, all government and corporate bonds, real estate, private companies, gold, even crypto. You can think of it as the truest benchmark for the entire global market. And here's the breakdown. Check this out. Public stocks and bonds, they make up a staggering 86% of the entire thing. Everything else we hear about, gold, private markets, real estate, crypto, that's just a tiny sliver. This right here, this is our first big clue that owning everything might not be as diverse as it sounds. Now, this portfolio isn't sitting still. There are three huge trends shaping it right now. First, stocks have gotten much, much heavier in the mix since the '08 financial crisis. Second, the United States has become the undisputed heavyweight champion in both stocks and bonds. And third, while alternative assets get a lot of buzz, they're still just a tiny fraction of the total pie. And this concentration is it's staggering. When you buy a so-called global stock fund, what you're really buying is a portfolio that is nearly 2/3 American. And that's largely driven by the monster outperformance of just a handful of U.S. tech giants. The U.S. market's weight simply dwarfs every other region combined. This is a crucial point, and we're going to come back. Okay, so this all leads to a really important question. If you own a piece of everything, shouldn't that be the perfect, most diversified investment you could possibly make? Well, as it turns out, the reality is a whole lot more complicated. In fact, just blindly buying the world portfolio has some serious hidden flaws. We're going to look at three major cracks in this global benchmark. The first crack is that it's deeply imbalanced. Remember that donut chart we just looked at? With 86% of the portfolio in just stocks and bonds, it's super tilted towards traditional financial assets. And that makes it really vulnerable when those two things move together. And here's where the danger really kicks in. The analysis points out that in an inflationary environment, like the one we saw in 2022, both stocks and bonds can fall at the exact same time. So in a portfolio that's almost entirely made of stocks and bonds, there's just nowhere left to hide. The second crack is that extreme U.S. dominance. Having 64% of your global stocks in one single country, even if it's the world's largest economy, is a huge concentration risk. You're basically making a massive bet on one country to keep outperforming forever. And history shows us that U.S. dominance is not a law of nature. Back in the 1980s, it was Japan's market that seemed absolutely unstoppable. Market leadership has shifted before, and you can bet it will shift again. And the third crack is that the benchmark is just too narrow. By focusing only on the biggest, most popular assets, it completely misses out on the powerful diversification benefits you can get from some of those smaller alternative assets. And the data totally backs this up. The source shows that a simple world portfolio has a risk-adjusted return, or Sharpe ratio, of 0.47. But a risk parity strategy that thoughtfully includes some of those smaller assets, it achieved a much higher 0.71. That basically means it delivered way more return for each unit of risk it took. The bottom line is, being too narrow can really cost you in performance. Okay, so we've seen the problems. The world portfolio is imbalanced, it's US heavy, and it's too narrow. So what do we do about it? Let's look at how sophisticated investors tackle these exact flaws to build much more resilient portfolios. And the great thing is, the solutions line up perfectly with the problems we just talked about, which gives us a really simple and powerful framework. You've got to balance the mix of assets, actively manage your regional exposure, and broaden your horizons to include alternatives. First up, you balance the mix. And we're not just talking about the classic 60-40 here.
This is about strategically including real assets, things like gold or infrastructure, that can actually do well during inflation when stocks and bonds might be struggling. It's about building a portfolio for all seasons, not just for the sunny days.
Second, you actively manage your regional exposure. So instead of just passively accepting that two-thirds of your portfolio is in the US, you make a deliberate choice to diversify internationally. Look, this isn't about being anti-US, it's about being pro-diversification and managing that concentration risk. And third, you broaden your horizons. This means looking beyond the public markets to find new sources of return. Assets like private credit, venture capital, or certain hedge fund strategies, they often behave very differently than stocks and bonds, and that can provide powerful diversification right when you need it most.
So what's the big takeaway here? It's that the idea of the market is far bigger, far more complex, and way more dynamic than any single benchmark could ever hope to capture.
So let's sum it all up. The world's portfolio is a useful concept, a $250 trillion beast, but it is not a perfect strategy. It's imbalanced, it's heavily concentrated in the US, and it misses out on key diversifiers. The smartest investors don't just follow the map, they actively work to improve it.
You know, the forces that made the US the dominant market for the last decade might not be the same forces that drive returns for the next decade. And the crucial question this leaves you with is this. As the map of the global market continues to change, is your portfolio built to navigate the world as it is, or the world as it's going to be?